On January 22, 2026, the geopolitical landscape shifted permanently. After a year of intense tension, the United States officially finalized its withdrawal from the World Health Organization. While the headlines focus on health policy, the real story is the money. This isn't just a departure from a health agency. It is a fundamental restructuring of how the world's largest economy interacts with global institutions. By cutting ties with the WHO, the US is signaling a move toward financial sovereignty, a theme that is currently rippling through every corner of the market. Investors are watching closely as the US moves its personnel out of Geneva and freezes hundreds of millions in funding. This move challenges the post-World War II financial order, where globalist institutions relied on American capital to function. We are entering an era where zero-sum economics replaces global cooperation. For the average person, this might seem distant, but as we'll see in this video, the impact on your portfolio, the dollar's strength, and the future of global trade is immediate and profound. The exit is the first domino of a much larger game of economic realignment. Every divorce has a financial settlement, but this one is messy. As the US walks away, it leaves behind an estimated $280 million in unpaid dues. The Trump administration has labeled this bad debt, refusing to pay for what they call a failed service. However, the WHO views this as a breach of international law. In the world of finance, arrears matter. When the world's superpower refuses to pay its bills to a major international body, it sets a precedent for how other debts might be handled in the future. This standoff is a micro version of the larger debt crisis we see globally. If the US can walk away from its institutional obligations, what does that mean for sovereign debt or international trade agreements? This creates a trust deficit. In finance, trust is the only thing that gives currency value. If the rules of the game are being rewritten in Geneva, they are likely being rewritten in the bond markets as well. We are witnessing the birth of a more aggressive, transactional form of diplomacy, where every dollar spent must have a direct, measurable return for the American taxpayer. For the WHO, the US exit is a fiscal heart attack. The United States was the largest contributor, providing nearly 20% of the agency's total budget. Without that cash, the WHO is facing a 25% reduction in its global workforce by mid-2026. This isn't just about losing doctors, it's about losing data. The WHO's primary product is global health intelligence. In finance, data is the most valuable commodity. Markets rely on who reports to predict supply chain disruptions, labor shortages, and travel restrictions. Without a well-funded central intelligence hub, the world's markets are flying partially blind. When the WHO's budget is slashed, the risk premium for international business goes up. Companies that operate in emerging markets now have to factor in the cost of their own health surveillance, as they can no longer rely on the WHO's infrastructure. This leads to higher operating costs and lower profit margins from multinational corporations. The collapse of the WHO's budget is a direct tax on global trade efficiency, and the ripple effects are just beginning to show in quarterly earnings reports. As public funding for global health vanishes, a massive vacuum is opening, and private capital is rushing in. We are seeing the privatization of global health. Giant investment firms and private foundations are now the primary financiers of health initiatives in developing nations. While this might seem efficient, it changes the financial incentive. Private capital seeks a return on investment. This means we are moving away from general wellness toward profitable medicine. For investors, this is a massive opportunity in the biotech and pharmaceutical sectors. However, for the global economy, it creates a fragmented system where health data is proprietary rather than public. In the world of finance, this means that the next pandemic or health crisis will be managed by entities that prioritize shareholder value. This shifts the risk profile of every major stock index. We are moving from a world of shared risk managed by a public body to a world of targeted risk managed by private equity, the US. Exit has essentially turned global health into a trillion-dollar private market, with all the volatility that entails. The WHO withdrawal is a major plank in the America First financial platform. By pulling out, the US is prioritizing the strength of the domestic dollar over international cooperation. This financial nationalism is designed to reduce the outflow of capital into organizations that the current administration views as inefficient. In the short term, this can lead to a stronger dollar, as the US retains more control over its capital. However, the long-term risk is the de-dollarization of global institutions. If the US isn't funding these bodies, other nations, namely China, and the BRICS alliance will step in to fill the gap using their own currencies. We are seeing a currency war play out through health funding. Every dollar the US pulls out is a yuan that China can put in to gain influence. For your personal finances, this means the dollar's role as the world's reserve currency is under a new kind of pressure. You aren't just watching a health debate, you are watching a fight for the future of the global monetary system, where the US is betting that independence is more valuable than influence. The pharmaceutical sector is in a state of high-stakes transition. Previously, the WHO acted as a global gatekeeper for drug approvals and patent regulations in the developing world. With the US out, American pharma companies may face fewer regulations, but they also lose the protection of international standards. This is a double-edged sword for investors. On one hand, companies can move faster and charge more in a deregulated environment. On the other hand, without the WHO's stamp of approval, it becomes harder to enter new markets with consumer trust. We are seeing a surge in medical protectionism, where countries create their own regulatory hurdles to protect domestic companies. This fragments the market. Instead of one global standard, pharma giants now have to navigate a maze of 190 different sets of rules. The cost of legal compliance and market entry is skyrocketing. For your portfolio, this means the era of big pharma having a smooth, global runway is over. Success will now depend on which companies have the best geopolitical risk teams, not just the best scientists. In finance, there is no such thing as an empty space. When the US leaves the room, someone else sits in the chair. China has already signaled its intent to increase its voluntary contributions to the WHO to offset the American exit. This is a strategic value play. For a fraction of the US defense budget, China is buying the leadership of a global institution that influences the lives of billions. This has massive implications for global trade routes and the Belt and Road Initiative. By controlling the health standards of developing nations, China can effectively control who gets to trade in those regions. This is soft power with a hard financial edge. American companies may soon find that their products don't meet the new WHO standards set by their competitors, the US. Exit might save $280 million today, but the opportunity cost of lost influence in the global markets could be in the trillions over the next decade. Investors need to understand that global influence is an asset, and the US has just liquidated a significant portion of that asset. Global supply chains are built on the assumption of stability. The WHO provided an early warning system for health-related disruptions. Without American participation and funding, that system is significantly weakened. This increases the volatility index VIX for global shipping and manufacturing. If a localized health crisis in a manufacturing hub isn't caught early due to lack of WHO surveillance, it can spiral into a global supply chain freeze. We saw this in 2020, and the financial cost was staggering. By withdrawing, the US is essentially self-insuring its supply chain. Large American companies are now forced to build their own private health intelligence networks. This is an enormous capital expenditure that doesn't produce any goods or services. It's purely defensive. This dead capital reduces the overall efficiency of the economy. For consumers, this means higher prices, as companies pass the cost of this private surveillance down to the end user. The WHO exit is, in effect, an invisible inflationary tax on every imported good you buy, as the world becomes a riskier place to move products. The withdrawal is also forcing a massive shift in environmental, social, and governance ESG investing. For years, the WHO was a primary benchmark for the S in ESG, social responsibility and global health. Now, fund managers are having to rewrite their playbooks. Without a central global authority, how do you measure a company's social impact in health? This is leading to a wild west of ESG metrics. We are seeing a bifurcation of the markets. European funds are doubling down on who-line standards, while American funds are moving towards sovereignty-based metrics. For investors, this makes cross-border investing much more difficult. You can no longer assume that an ethical fund in London means the same thing as one in New York. This lack of standardization leads to capital inefficiency. When money can't move easily between markets because the rules are different, growth slows down. The US exit from the WHO is a signal that the global ESG standard is dead, replaced by a world of competing, localized values that make global capital allocation a nightmare. Emerging markets are the growth engine of the global economy, but they are also the most dependent on who infrastructure. Countries in Africa, SE Asia, and Latin America use who resources to maintain a healthy workforce. With those resources cut, the human capital risk in these regions rises significantly. For investors in emerging market ETFs, this is a major red flag. A single and contained outbreak can now wipe out the GDP growth of an entire region because the global fire department has been defunded. We are seeing capital flight from the most vulnerable nations as investors move their money back into safe haven assets like gold and US treasuries. This creates a vicious cycle. As health funding drops, risk rises. As risk rises, investment leaves. As investment leaves, the country's ability to fund its own health programs collapses. The US exit is effectively de-risking American portfolios by in-risking the rest of the world. This creates a more polarized global economy, where the gap between the stable North and the volatile South grows wider every day. The US biotech sector is currently a tale of two cities. On one hand, the government is redirecting who funds into domestic biosecurity and private American research. This is a massive stimulus package for US-based biotech companies. We are seeing a boom in nationalist science, where the goal is to create American-only solutions to global problems. This could lead to a massive short-term spike in the stock prices of domestic biotech firms. However, the bust side of the equation is the loss of global collaboration. Science thrives on shared data. By siloing American research away from the global community, we might actually slow down the rate of innovation. In finance, innovation lag is a silent killer of long-term value. If American biotech becomes an island, it may lose its competitive edge against a globalized scientific community led by Europe and China. Investors must decide, are they betting on a short-term stimulus or long-term innovation? The WHO exit has made that choice the most important decision in the healthcare sector today. So, how do you protect your finances in this new, fragmented world? First, you must recognize that the globalized era is being replaced by the sovereign era. This means diversification looks different now. You can't just buy a global index and hope for the best. You need to look at geopolitical resilience, focus on companies with strong domestic supply chains, and those that aren't dependent on international regulatory bodies. Second, watch the currency wars. As the US pulls back, the dollar's role will be challenged. Consider holding a portion of your wealth in hard assets, like gold or decentralized finance DeFi, that aren't tied to institutional stability. Finally, understand that information is the new gold. With the WHO weakened, the first to know about a global crisis will make the most money. Follow the data, not the headlines. The US exit from the WHO is a warning shot. The old rules of global finance are gone. The winners of the next decade will be those who can navigate a world where every nation and every investor is truly on their own. Stay powered, stay focused, and stay free.